Hello everyone, I'm Ken Green from Bitstalk Investments and welcome to today's video. This is the second video of the Real Economy versus Financial Economy series, and today we're going to be covering the financial economy. So this is a chart that baffled a lot of economists, a lot of journalists a few months ago, and you can see that we have unemployment up 10%, and at the same time the market is up 35%. And this is confusing because you'd expect with unemployment increasing, so people's wages decreasing, their spending power is decreasing, you'd expect that businesses, as reflected by the stock market, would be going down in value during this time period. But in fact, the complete opposite happened and the market was actually up 35%. So we're going to have a look at why this is the case, why we can have these dislocations, and you should be able to explain this chart by the end of the video. So the financial economy describes the aspects of the economy such as stock, currency, derivatives, and other financial assets. Whereas the real economy is used to affect non-notional transactions, e.g. wages paid for labor or prices paid for a good. So you can immediately see this contrast here, where there's something much more tangible being transacted in a real economy. There's an output attached to the transaction, whether that be goods or labor. Whereas in the financial economy, we can just be swapping ownership rights, we can just be swapping dollars for euros with no tangible output being created there. So in order to have a healthy economy as a whole, we need both of these elements to be working, to be in good health. If one of the aspects, whether that be the real economy or the financial economy, lag behind, then we're going to have some problems. And the way we assess the health of the financial economy is we can look at the price. So the price reflects the balance of demand and supply, and also the optimism and pessimism of the market participants is baked into that price as well. Liquidity refers to the ease in which you can move in and out of the market without moving the market price. And that's most relevant when the market is crashing and everyone's trying to get out at once. So that's when you're going to get a liquidity crisis, because there's an imbalance of sellers and buyers. And then finally, there's quality. So certain products such as loans or structured products, so CDOs and CLOs, they will have ratings attached to them by credit rating agencies. And the quality of those ratings will change over time. So loans might be downgraded by the rating agencies if they see the risks of the issuers of those loans failing to pay back increase. So the relationship between the real economy and the financial economy. So you can think of the real economy as the foundation on which the financial economy is built. However, there are two other big factors that go into the health of the financial economy. So first is what's relevant with the financial economy are the changes in expectations of economic data rather than the economic data at face value. So what matters is whether the actual outcome of the unemployment figures is better or worse than the expectation of those figures, rather than the figure at face value. And then we have market mechanics. So we have things like the knock-on effects of derivatives markets, and also one example could be pension mandates and monetary policy consequences. So for example, in this low interest rate environment with the central banks continually decreasing the interest rate, these pension mandates may still have a requirement to get a return of 10% a year, let's say. And they can no longer get these required returns from government bonds. That means they're going to have to move out into the risk spectrum in order to chase this yield and move into riskier assets, causing those market prices to rise. And that has no fundamental, no real economy influence whatsoever. It's just pure market mechanics. So a common metaphor for this relationship between a real economy and a financial economy is like a man walking a dog. So you have this dude walking across the park here, and if you watch the way he moves, his strides, it's fairly straightforward, and it has very few deviations like an economic trend. And then when you compare that to what the dog is doing, the dog's running around like a maniac. It's shooting to the left, shooting to the right, and it's running over there and sniffing another dog's ass. And that's the stock market right there. So essentially, they both end up in the same place, but there's just a lot less deviation in the movement of the real economy compared to the financial economy. And now you should have a rough idea as to how we can get this, because the economy and the market move in the same direction, but not necessarily with the same path. So in the short term, you can get these big deviations. And if we compare this chart to 2008, looking at unemployment and the S&P 500, it's basically the exact same pattern. And next, we're going to have a look at the first thing we talked about, which were expectations compared to actual outcomes. And we can see that's what really fueled this rally, rather than, again, it didn't matter that unemployment was high. What mattered was it wasn't as high as expected. So as we can see on the 1st of May here, that's when we started first getting actual results beating expectations. So why does this matter so much? Well, the stock market is a forward pricing machine. So it bakes in expectations about news and economic events into the stock price today. So when the actual result comes out as better than expected, well, the price that was before the news event no longer reflects the price it should be after the news event, because now the price needs to increase to account for better conditions that were then were baked in before. And then the opposite is true. So when we started having actual results worse than the expectations, then the stock price needs to decrease to account for this. So the key point here is that it doesn't matter if the news is good or bad at face value. What matters is its relative value compared to the expectations. And then we also have market mechanics. So I'm sure you've seen a lot of these Forex gurus, these Forex billionaires on Instagram flashing their brand new Lamborghinis, possibly rented Lamborghinis. And there's been this huge boom in retail traders over the past year. And, it's referred to as this retail mania. So quite often, these traders are all buying call options. And to explain this simply, they have a very lopsided positioning on the market. And the players on the other side of this market, on the other side of this trade, the market makers, so these are the guys that are facilitating the trades, they just want to earn the commission on these trades, not necessarily have a position in the market. So in order to hedge these lopsided positions, it has a strange effect of actually increasing the movement, in this case, to the upside. So this is a phenomenon called the tail that wags the dog. So usually the derivative is priced on the underlying asset. But in this case, the underlying asset, the derivative, is actually waggling the market, is actually having an impact on the underlying asset. And again, this has no real economy influence whatsoever. It's just pure market mechanics. Okay, so to summarize, the real economy and the financial economy, they both move in the same direction and they usually end up in the same place. However, in the short run, we can have these huge deviations because of one, what matters is expectations compared to actual outcomes rather than the actual outcome. So the real economy could be doing badly, but if it's not doing as badly as expected, then the market can still go up. And two, because of market mechanics. So today we mentioned pension mandates and interest rate policy, and also market maker hedging procedures, causing underlying price moves to increase even more. So I hope you learned something new today. Thank you for watching. And with that, have a great day.